proactive value acceleration is a key part of every VC fund manager's investment strategy. It must be. And you can see from this that corporate venturing, when they get it right, can give their portfolio companies a huge competitive advantage, not just by providing financial capital, but the intellectual capital necessary to fast-track breakthrough ideas into the market by hitting these key milestones. And we know this works because when you look at recent history, you'll see that a large number of the world's most valuable companies have corporate venturing units as their investor base, as their early investor base. And that early investor base, that corporate venturing synergy, has allowed those companies, in part, to fast-track their growth. So, how do you put together a corporate innovation and venturing strategy, and what does this mean for emerging technology companies? What does it mean for pure VC in the market? As I mentioned earlier, the strategy for each corporate is going to be different because the things that they want to achieve from the strategy and the things that they have to contribute to the strategy in almost all cases will be slightly different. So there is no one corporate innovation and venturing strategy that's going to work across all corporates. But there are some common principles that you can apply no matter what business you're in for thinking about how you do this and beginning, I suppose, to sell this to your boards. And again, this is very high level, but it looks a little bit like this. The most important first step is to define and to document the core objectives and outcomes that the corporate is seeking to achieve from the strategy. Now, I know that sounds obvious, but let me tell you, the number of times I've had people approach me with a solution that didn't have a strategy is extraordinary. You always have to backtrack. You always have to go back and say, you know what, let's just put the solution to the side for a moment and go back to what you're trying to achieve here. Because without a clear understanding of that, your solution may not be exactly right. And defining objectives, whilst it sounds obvious, I'm going to give you a couple of examples of why it's not quite obvious. One example of an objective that some corporates seek to achieve from their corporate innovation and venturing strategy is branding and marketing. There's absolutely no doubt that a corporate innovation and venturing strategy adds brand value to most legacy institutions, especially in this environment where entrepreneurship and innovation is the buzzword from federal politics all the way through to the big boards across the country. And for some organisations, that's enough. My personal view is that that approach lacks any real meaningfulness. If you're going to go to the trouble of allocating a marketing budget to an innovation strategy, it makes much more sense to continue that journey and put in place meaningful processes to integrate that strategy into the business so that you can contribute real value to it and you can extract real value from it. The second one that comes up a lot is this idea that we want to attract and retain our top talent. This one's very interesting to me because I think that at all stages of the talent spectrum, from undergraduates in university all the way through to top technical, highly trained executive talent, organisations are witnessing more and more an exodus of some of their best people in favour of following the path of entrepreneurship. And as the national dialogue around innovation entrepreneurship continues to gather momentum, and it will over the next 12 months, that trend is going to continue. Corporate Australia is going to find it harder and harder to attract and retain talent which is valuable to the client of the new digital economy, right? Valuable to the client of the new digital economy, not the client of old. So you might be able to attract technically smart people, sure, but you'll struggle to attract creative geniuses, the innovators, those with an entrepreneurial mindset who can speak the language of your client. Even here at PwC, we have addressed that challenge by implementing policies which encourages our people to build their startups on the side and stay here, right? Because after all, what could be more valuable to a client than someone who's actually doing it or has actually done it? So attracting and retaining talent, how important is that in your strategy? Then there's the idea of accelerating internal innovation. This is about fast-tracking known internal challenges of a corporation, known internal opportunities of a corporation. My favourite non-example of this is the blockbuster Netflix story. Now, I know we all know how that ended, but what you might not know is that in the spring of 2000, the Netflix executive called a meeting with the executive of Blockbuster in Dallas, which is where they're headquartered, and they offered to sell 49% of Netflix to Blockbuster in return for taking Blockbuster.com and becoming Blockbuster's online strategy. Blockbuster obviously said no to that offer and continued to try to build a digital business on their own with failed strategy after failed strategy after failed strategy until in 2010 they filed for bankruptcy in the US. These days, my observation is that corporates are much more willing to outsource that sort of R&D where it relates to internal challenges and opportunities. And that, I think, is going to be a continuing trend. And finally, the idea of future-proofing your business. This is about identifying and engaging with the new, the unknown, the unimagined product innovation and business model innovation. Again, using the Blockbuster example for a moment, the pivot of the delivery of entertainment into on-demand digital streaming from what was putting a DVD in the mail, right, was something that was completely outside Blockbuster's radar. And this is quite extraordinary when you think about the fact that Blockbuster was in part owned by Viacom, which is one of the world's largest mass media companies, completely outside their radar. So future-proofing, and this is the challenge with future-proofing, because this is possibly the hardest and the most humbling of objectives to get your board to accept, because what it means is somebody's got to agree that there are potential future innovations that are capable of significantly impacting your business that you just can't know about. Very difficult for a board to accept that, right? But it's essential in my view. So once a corporate understands exactly what it is it's trying to achieve from such a strategy, the next major challenge is how do you get real exposure to the best of breed emerging technology companies that are relevant to your sector and that are relevant to your business. So with the opportunities in the market as attractive as they are, with more incubators, accelerators and co-working spaces in Australia than we've ever seen before, and rising with the federal government and state government, with innovation policy right at the top of their agendas, there are more startups being built in this country now than at any time in my recent history, my recent memory. And that makes it very, very difficult because a lot of those startups will be working on the same problem, on the same solution, possibly on the same idea, each with a different talent pool, different prospects for success. How do you filter through? How do you attract, identify and filter through that number of potentials in order to understand who are the best of breed for your sector and for your industry? And then third, once you've done that, how do you engage exactly with those kinds of companies? Once you've identified opportunities that are relevant to your particular business sector, the next challenge is how do you engage? Do you need to invest hard cash to achieve the objectives that you've set out at the beginning? Or are there other arrangements that can be just as effective and give both the corporate and the technology company what they need? Do you, for example, add just as much value by entering into a strategic alliance or a distribution arrangement, or simply becoming a customer of that product or service? We talked before about the importance of customer acquisition in the growth journey. Simply by becoming a customer, an early customer of an emerging technology company, corporates can add significant amount of credibility and value to the customer acquisition journey. For example, NAB is one of my early customers. When you have that conversation with the rest of your prospective client base, that's going to hold some sway. What does that mean for an early corporate? What is it worth? Is it worth equity, for example? Do you need to put in cash? So corporates need to lock in the circumstances in which they will actually invest cash, when they will acquire, when they will enter into a partnership, when they will enter into a strategic alliance, when a distribution agreement makes sense, or when simply becoming a customer is the best way to engage, and what do they think that assistance is worth? And then finally, synergy realisation, which basically means once you've identified the opportunities and determined your method of engagement, the next key challenge for corporates is going to be to have in place the processes to accelerate value by realising the synergies that you identified up front in the assessment process. What does that mean? That means leveraging the brand, actively leveraging credibility, customers, distribution, resources, IP, know-how, networks, relationships to fast track that growth journey. These are assets that corporates have in spades, but having a process with which to connect that into your deal flow is essential and is often the piece that's missed. So let me wrap up by saying this. I think it was Malcolm Turnbull. There has never been a more exciting time to be an Australian venture capital fund manager. Nor has there, in my view, been a more exciting time to be an Australian entrepreneur. I genuinely believe that. This is the age of the entrepreneur. This is the century of ideas. I believe that. And even though, as Jack Welch said, the rate of change on the outside today is greater than it's been in recent memory, corporates have a unique competitive advantage in venture. Corporates have a unique competitive advantage in venture because they have the power to bring not just financial capital, but intellectual capital, which is ingrained in their organisation, to fast-track breakthrough innovation into the market, to bring the brand, the credibility, the customers, etc. And that is what is going to drive the digital economy of the future.